Very good morning to all. Yesterday we completed the first chapter of statistics. Now today we are starting the first chapter of accountancy in our subject. And as you all know, today is the last day to submit your works. If you are not submitting, then you know the thing what will happen. Okay, so directly starting from the chapter number 1 without wasting any time. Okay, so all we are having 2 parts for accountancy and 2 parts for statistics, and the first part of accounting covers 7 chapters. In that, last 3 chapters are very lengthy. Okay, now we are going for the first chapter, that is Introduction to Partnership. Friends, in 11th standard we have learned the concepts about the sole proprietorship form, where we have one owner in the business and other are the employees. Now we are going for the second type of business, that is a partnership business. In sole proprietorship form there are only single owner running the business, and in partnership form now we are having more than one person, means minimum 2 persons there are to run the business. And as we have seen, the number of partners can be 50 or 100 according to the government rules. That is a different thing. But now we need to understand that what is actually the partnership. Partnership is such a thing that 2 or more persons come together to run the business and their main objective is profit. 2 or more persons by contract, by written contract or by oral contract, coming together for a common objective, and that common objective will be always profit. Because as we all know, for what we are doing the business, we are doing the business for profit. So this is partnership. And partnership firm, firm means a business. A business which has more than one owners is called a partnership firm. Okay, minimum and maximum numbers we have written in the theory part. Now we are looking what they have written. Okay, now meaning and definition of partnership. Section 4 of the Indian Partnership Act 1932. Everyone should remember that the year of Partnership Deed Act is 1932. Defines partnership as: partnership is the relation between the persons who have agreed to share the profit of business carried on by all or any one of them acting for. It is not compulsory that all the partners are active in the business. It is only compulsory that the main objective of the business is profit. Now it is possible that some partners are only sleeping partner, means they have given their money, they have given their capital to run the business, but actually they are not managing the business. So thing is given that the common objective should be profit, and what thing they anyone of can run the business, or everyone can run the business. The person who enter in such a relationship are individually called partners and collectively called a firm. Individually they are a partner, collectively they are a firm. Firm means a business. From the above definition, it can be said that 2 or more persons who are competent to undertake a contract to earn profit from a legal business, the business is termed a partnership. Okay, business should be legal, the business should not be illegal. The business run collectively in a partnership by 2 or more persons is called a partnership. There are some characteristics we will see. It is important for the creation by contract. Partnership is created by contract. Okay, that contract can be written or can be oral. Profit objective. Main objective for collectively running the firm is only profit, no other objective. Number 3. Legal business. The business they are running, that should be legal. Agent of each partner means the partners who are doing the business must report to each other. It should not be like that A, B, C are the partners. Now A is such a person who does not talks with anyone, who does not discuss anything with other. Now that is not possible in a partnership business. You should talk to each other, you should communicate to each other, and you should report the things to each other. Number of partners. The section 464 of the Companies Act 2013 empowers the government to prescribe maximum number of partners is 100. The government has prescribed maximum number of partners to be 50 in wide rule. Normally it is 100 and according to a rule it is a 50. Unlimited liabilities. Now as we have seen in standard 11, a sole proprietor doing the business or number of partners doing the business, their liability is unlimited. Now what do you mean by this unlimited liability, friends? The unlimited liability means if you are doing the business, and if you are incurring the losses more than your capital, if you are incurring your losses more than your capital, then your personal assets from your house can be recovered, can be sold for paying the outside liabilities. What is the meaning from that? Suppose A, B, C are three partners in a business. Now their capital is 1 lakh each, so their capital is 3 lakh. Suppose they are incurring a loss of rupees 4,50,000. They are incurring a loss of rupees 4,50,000. Now the remaining 3 lakh from 4,50,000 is 1,50,000. Their personal assets are to be taken from their houses and can be sold to recover their losses. But this thing does not exist in a company form. Company form has limited liability where partnership and sole proprietor has unlimited liability. And last, ownership and management of the firm. The partners are also the owners, they are also the managers. Okay, it is possible that they can assign some other person as the manager also. So these are some of the characteristics of partnership. And partnership deed means a written contract between the partners, that is partnership deed. Okay. Now what are things that are included in the partnership deed? We are just reading the names, the details of the partner, details of the what type of comments means you are starting the partnership, capital, how capital will be brought by each and every partner, interest on capital should be charged or not, drawings, how much drawings is allowed from the business. Now friends, in 11th standard there was no such rules that how much drawings you should do, how much capital you should draw. But why here in partnership it is important? Because there are 3 partners or 4 partners or maybe 2 partners, but both are different persons, both are from different maybe house or maybe different area. Now we will think that if one partner withdraws so much capital from the business and other is always struggling to invest in the business, now this is unfair with the partner. One is enjoying and withdrawing the money regularly while one person is always struggling for this business. Now this is unfair. So for equality between both, before starting their partnership they will decide that you can withdraw this much amount and I can also withdraw this much amount. If the amount is more, they cannot withdraw. Then again, for withdrawing this thing, can we charge interest for drawings or not? Then in what ratio we will distribute the profit or loss, which is given in page number 3, distribution of profit and loss. Then salary, bonus, commission and remuneration to the partner. One partner is very actively working for the business, then can we pay extra money to them, extra money in the form of salary, bonus, commission, etc. Interest on loan provided by the partner to the firm. So in middle itself it is written 6%. If any partner has extra money and he brings that extra money as loan, he is giving loan to the business, not business is giving loan. A partner is giving loan to the business. Now what interest is to be charged if nothing is mentioned in the deed? 6%, and if it is mentioned 12%, then we can give 12%, 15%, anything. But if nothing is mentioned, then we have to give compulsorily 6% interest per annum. Goodwill. Goodwill shows the reputation of the business. So in what way this goodwill is to be shown in your balance sheet? Admission or retirement. Are we allowed to admit a new partner? Are we allowed to retire a partner? Dissolution of the firm means if the business is not going good, then if it is possible, then we will close the whole business and we will discontinue the business. So all such things are written in the partnership deed. Now again they are writing a note that all this is for your information. You should know. This is not a thing that it will not come in exam exam, so you should not see these things. These things are important for your base study, for basic study in this chapter. Now, on page number 3, fifth point, provisions of Indian Partnership Act 1932 pertaining to accounting treatments in the absence of partnership deed. Okay, these are you asked for the unit test. That is a good thing that everyone has attended, and how they have attended also I know. But this thing cannot be asked in exam, but this thing is to be remembered for the sums. If you are not remembering these provisions, then in sums you may make many of the mistakes, and sometimes it is possible the whole sum is wrong. So very carefully we are understanding what is this deed and what is if there is absence of partnership deed, as we have seen in the previous page. A partnership deed or a partnership contract can be written or can be oral. Oral means from the mouth we are discussing that I will give this much capital, then other person is saying I will give this much capital. Okay, now that is the thing. But we have not done anything in written. So it is possible that one of the partner can do misinterpretation of that thing, and he may provide fraud to the business. So government has decided some of the rules, that if the partnership deed is not prepared, we have seen what 14 points have been seen in the partnership deed. Now if the business does not have any such contract, then what all the things are compulsory, we will see. The following provisions of Partnership Act 1932 will be applicable if no partnership deed is prepared or no clarification is made in the deed. If there is no clarification between the partners, then what things we have to be remembered? Number 1. Each partner contributes capital in the firm by mutual agreement. There is no restriction in the act in this regard. It is not mandatory, means it is not compulsory to bring capital for each partner. The first thing is capital, friends. If we have not decided or if we have not clarified anything in the partnership contract about the capital, then what is the thing which will apply? That it is not compulsory for each partner to bring the capital in the business. Moreover, the capital is brought by mutual agreement, means anyone can bring any amount as capital. It is not compulsory that minimum you have to bring this much as your capital. Capital means an investment in the business. Number 2, interest on capital of partner cannot be paid. If we have not prepared a written contract, then interest on capital cannot be paid. There is no such percentage which are fixed to pay interest on your capital. Number 3, distribution of profit and loss would remain in equal proportion. You have brought different capital. Suppose partner A is bringing 5 lakhs, B is bringing 3 lakhs, C is bringing 2 lakhs. Now they have brought the capital in 5:3:2. But that does not mean that you have to distribute your profit in 5:3:2. It is also by mutual agreement. And if you have not decided how much capital or how much profit each partner will get, then what is the thing you should remember? The profit and losses will to be distributed in equal proportion. Interest on drawings cannot be charged. Same like interest on capital, interest on drawings also cannot be charged if no percentage is given. Now this will be applied in the sum also. In the sum, question will be such that partners have not decided percentage of interest on drawings or capital. Then what percentage will you charge? Then what you will write? Interest on drawings or interest on capital cannot be charged. Now don't charge 6% for that. 6% is only for the loan given by the partner. Salary, bonus, commission, remuneration also cannot be paid if you have not fixed it. 6% per annum interest is payable for the loan given by the partner to the firm. If any partner is giving loan to the business, then per annum 6% interest is chargeable. Number 7. In case of any reasonable expense incurred by a partner for the firm, the partner has the right to reimburse it. Reimburse means to get it back again. Suppose A, B, C are the partners. A is doing expense for the business for rupees 50,000. So the B and C is liable to pay him their part. Means for 50,000, if we are making 3 equal parts, then it is almost 16,666. So each partner has to give 16,666 to A. B and C will give to A. Suppose we four friends are going in the hotel. Then what you are doing? You are distributing the bill. In the same way, this expense also partners will distribute within each other. One will pay and others will distribute it. Okay. On page number 3 again, new heading, capital accounts. Okay, friends. In standard 11th, capital accounts were not prepared in final accounts. Final accounts had trading account, profit and loss account, and balance sheet. Also, the calculation for capital was on the liability side of balance sheet. As such, we have to write the heading capital. Then what you will write? Opening capital plus additions plus interest on capital plus net profit, and we will add these 4 items, and then we will subtract drawings, interest on drawings, and net loss, and finally the balance which is remaining we will write it outside, and that outside balance is known as closing capital. Now if there are 4 partners in the business, you have to calculate this thing 4 times. If there are 3 partners, then you need to calculate it 3 times. Now this is not practically possible. It will consume more and more time, because to write this format one time we need more time. Now if you need to write this format 4 times, then you will consume more time. So instead, what accounting rules have decided, you will prepare a capital account. You don't need to show this calculation anywhere, but you just prepare a capital account which will include all these items. Now there are 2 methods to prepare capital account. There are 2 methods to maintain capital accounts in the books of partnership firm. Number 1, fluctuating capital method, and number 2, fixed capital method. Now what are these capital, fixed capital and fluctuating capital? In short, we will try to understand. Fluctuating means the opening balance will not be same to the closing balance, and fixed means the opening balance of capital will be same as closing balance. Now you will think that what remaining transaction where will go if the opening and closing balance are same. So we will prepare one more account for that. So in short, if you now we are only just discussing, we are writing the notes afterwards. In short, if we need to say that if we have to prepare the capital account through fluctuating capital method, then only one account is required, and all the transactions are retained in the same account. And if we need to prepare it by fixed capital account method, then we have to prepare 2 accounts, that is capital and current. Current means all the transaction, and capital means fixed transaction. So in such a way we need to prepare. Now for what these accounts are prepared, same like the base of 11th standard, that base is used in 12th for preparing the final accounts, and also 3 more new accounts will be there. So I need to say is that in standard 11th, final account, which 3 accounts you are preparing? Trading account, profit and loss account, and you are preparing balance sheet. Now I have kept the space is that in standard 12th you are having 2 or 3, there is option 2 or 3 extra accounts. Now which are they? See, this will be first, this will be second. Now one extra account, profit and loss, appropriation account. Now number 4, there are 2 parts, partners capital account, and number 5, balance sheet. Now just now we have discussed that there are 2 methods to prepare capital account. You need to prepare only partners capital account for fluctuating method, and if you are having fixed method, then partners capital account, partners current account. Means see, total there are 6. 1, 2, 3, 4 has 2 sub accounts, and last manage. Means in fluctuating capital method you will prepare only one account, and in fixed capital method you are preparing 2 accounts. Now friends, please be alert. Please have a good type of concentration. Otherwise, what is the problem in standard 11? Most of us had the problem with final accounts. And as you all know, due to Corona, there was no exam. So everyone is very happy that big sums have not been asked. We have directly promoted in standard 12. I don't need to say these words in the virtual class now live, because all are watching me. But the thing is important is that in standard 11, when there were only 3 accounts, at that time also we were with great problems of the sum. You were all thinking that how these sums are possible, how we will remember, how we will solve the sums, and this sum was carrying 12 marks in standard 11. Now in standard 12, what is the thing you know? You need to prepare 6 accounts, and the marks is only 11. 1 marks is gone, and plus the accounts are doubled. So I need to inform, or I need to request everyone that please be alert, otherwise everything will go from here. And again, you don't think that in 12th also you will be promoted directly to the college. Friends, this is not practically possible. So today I need to say frankly to each and every student who are watching me or not watching me, that please be attentive now, because now it is the time to start. If you are not starting at this time, many of you are still not started the statistics book also, I know, but this is the time, friends. Otherwise you think for one more year in 12th standard, only that thing I will say. Now what was I hoping? We are having for final accounts 5 or 6 accounts. 5 accounts when we are having this method, 6 accounts when we are having that methods. Now in this chapter what we will learn, these extra accounts. What are these extra accounts? Which all things are included? And then in second chapter itself we have all the 6 accounts for final accounts of partnership. So I am saying this account is little bit tough for everyone if you are not attending. Okay? Yes. So these 3 accounts has been discussed in the book. Just now we have seen, just for instance, don't take tension in that. For instance, what you remember, for capital accounts, there are 2 methods. That is fluctuating capital and fixed capital. For fluctuating capital, prepare only capital accounts. For fixed capital, prepare capital and current both. What are they? What are the transactions included, that we are discussing? But think about this thing. And one more new account, that is profit and loss appropriation account. Now friends, there are 2 accounts with same names, profit and loss account and profit and loss appropriation account. Now what is the basic difference between both these accounts? There is no difference, as we say. In standard 11, there was only single account to record expense and income. We know in the profit and loss account, debit side there will be expense, credit side there will be income. Now in standard 12, for distribution of the transactions we have 2 accounts. Means this profit and loss account, profit and loss appropriation account is a part of profit and loss account. उसमें से थोड़ा अलग हो गया है इसमें से. So what you need to do, you need to classify the transactions. The business expenses and incomes will be recorded here, and the expenses with partners will be recorded here. So this is the difference. And the second effect of profit and loss appropriation account will be always given in capital accounts, because the transactions with the partners are made with the capital or their current account will be recorded here. So this was the short explanation of these accounts. In detail we will see after completing the small sums of this chapter. Their difference is given, that is not required. Again, profit and loss appropriation is given, that is also not required. Now what the thing is required, what the thing I need to tell is that this chapter 1 carries 4 marks weightage in the boards. How much marks weightage? 4 marks weighted in the board. Now for that you will be asked one MCQ and a 3-mark sum from this chapter. Now the 3-mark sums are of 11 types. There are 11 types of 3-mark sum. Again, for what these 3-mark sums have been learned, all the 3-mark sums are adjustment for this final exams. So if you don't know the first chapter itself, you cannot solve second chapter, because second chapter has adjustments which we are learning now for 3 marks, and the same adjustment will be in that chapter also, second chapter, and the concepts of these all accounts are also in the next chapter. So you now think yourself how important the chapters are. Okay friends, so this was just an introduction. Now we are going that for the types of that sums. After completing that 11 types of sums, we will discuss about these accounts. So everyone, now write the name of the chapter. Now we are starting chapter number 1. Introduction to partnership. Name of chapter, also write four marks weightage in boards. The detailed weightage I will give when we will meet personally. But for instance, as we have written in index number chapter also, it was carrying 12 marks weightage. This chapter is carrying 4 marks weightage. Okay? Now that thing is also over. Now friends, directly give the heading types of small sums. Types of small sums. There is one sum for each type along with an illustration also. Now we are going for type 1. We are going for type 1. Give its heading calculation of profit or loss share, profit or loss share received by each partner. Calculation of profit or loss share received by each partner. This is the first type of sum. Now below to it write profit loss ratio. In short, what we will say, P&L ratio. So now every time I will write P&L ratio only, means you will understand what is P&L ratio. P means profit and loss ratio. Profit and loss ratio will be given total profit or loss will be given share of each partner in profit or loss is equals to, means a ratio will be given. Now each partner's share in profit and loss can be calculated through this formula or through a trick for the calculator, which I will also teach. Now share of each partner in profit and loss is equals to total profit or loss multiply share of partner divided by total share without using above formula, comma, using calculator trick also, comma, directly shares can be okay. This is about the first type of sum. Now we will solve the sum, but first again I will dictate for everyone. You have to write this in your notebook. Okay, I am dictating types of small sums. Type 1, calculation of profit or loss share received by each partner. First point, profit loss ratio, that is P&L ratio, will be given. Number 2 means don't give the numbers. Next point, total profit or loss will be given. Then next, share of each partner in profit and loss. How you will calculate it? Through formula, total profit or loss multiply share of partner divided by total share. Without using the above formula, using calculator trick also, directly shares can be determined. Okay, now in the exercise we are going for the sum. Friends, in the exercise, come to page number 30 and 31. Everyone, in the exercise, come to page number 30 and 31. In question number 3, answer the questions in brief. 1, 2 is given on page number 30, 3 to 11 is given on page number 31. There are 11 types of sum, small sums, and there are 11 sums to solve. Okay, so each sum we will solve by writing this way. Now these all things are important. In standard 12, same like these notes will be given so much. So what you have done in 11th standard you are not seriously taking. Now if you are not taking these things seriously, then you will not remember anything. Now type 1 sum is given in the fourth sum, that is page number 31. On page number 31, look at the fourth sum, that is first type. The profit and loss sharing ratio of Rajkumar, Kaushik and Sharma is 15:10:9. The total profit of the firm is 68,000. Determine share of profit of each partner. What I said, calculation of profit or loss of each partner. For that, profit and loss ratio, P&L ratio will be given. If it is not given, then 1:1 we know is given as 15:10:9. Second thing, total profit or loss will be given here. Total profit is given 68,000. Now we will use this formula first, and then I will teach how to solve in this way also. Okay, everyone. Write in the data. Rajkumar, Kaushik, Sharma. P&L ratio 15:10:9. Total profit 68,000 rupees. Okay. Share of each partner in profit. Here there is no loss, so just I will write the profit is equals to total profit multiply Okay. Now, share of Rajkumar. Share of Rajkumar. 68,000 is total profit. Rajkumar's share is 15 and total share is, I think, 34. Total share is how much? 15 plus 10 plus 9. Total share is 34. Divided by 34. 68,000 into 15 divided by 34 is 30,000. Share of Kaushik, 68,000 into 10 by 34. 68,000 into 10 by 34 is 20,000. Last, share of Sharma, 68,000 into 9 upon 34. 68,000 into 9 by 34 is 18,000. Now for checking is our answer correct or wrong? 30, 20, 18. See, it is 68,000. So this sum is asking, then we have to write each and every calculation. But what I said, we don't need to write anything. Directly we can distribute it through calculator also, but that is for next chapter. You need to learn it now itself. This was using formula. Now using calculator, you need to write this much thing only. You need to write this much thing only, but calculator trick I will explain to each and every one. Calculator trick. How directly can we distribute? This you don't need to write, okay? I am just explaining the thing, you don't need to write. 68,000 between Rajkumar, Kaushik and Sharma. 15, 10, 9 and total is 34. How you will distribute directly this thing using calculator? So understand this thing, friends. What is the first step to have a calculator in your hand? If you are not having calculator in your hand, then just watch the lecture now. After completing the lecture, take the calculator and try by yourself. But it will be better that those who are having calculator, please take your calculator in your hands, and the buttons which I am telling should be pressed. No other extra buttons. Okay. What is the first step to directly determine this thing? So first write the total profit. Total profit is 68,000. Everyone has written 68,000 in your calculator. See, I have written. Okay. 68,000. Divide 34. Why 34? One more time I will repeat for those who have not done this thing. Take your calculators in your hand. Write 68,000 I have written. Start with the total profit. Then total share. Divide 34. Don't press equal to button. We don't need that button. Divide 34. I have done divide 34. Multiply with first share, that is 15, and press equals to button. 30. Now for 10 and 9, how you will calculate? Now the buttons which I am telling, let this 30,000 remain in your calculator. Don't press any other button. Now what I am saying, we for 10 share, what you should do? Press again equal to button. Press 10, the second share is 10, again equals to button. We are getting 20,000. You can check the answer. Again for the third share, equal to 9 equal, you are getting 18,000. So once more I am repeating for each and every one. Write 68,000 total, divide by 34, then don't press equals to button. Divide 34, multiply first share 15, you are getting 30,000. Then for next two shares, don't multiply direct. Equal to 10, equal to 10, equal to, then equal to 9, equal to, your answer direct. But for this chapter, you have your calculations. But for next chapter, this calculation is not practically possible as the sums are very large. So in this way, you can calculate it in short using this calculator. Okay friends, so that's all for today. We have completed the first type. Write this thing and send me